A little over a week ago, the 16th largest bank in the United States, Silicon Valley Bank, collapsed. Customers panicked after the bank announced it would be selling several billion dollars in shares to cover huge financial losses, precipitating a classic bank run. The bank's failure threatened to wipe out many tech startups, venture capital firms, and other American businesses, large and small, that kept deposits there. Something in the neighborhood of $150 billion held at the bank was not backed by the federal government because it was in accounts larger than the FDIC's $250,000 limit. The panic looked like it was spreading to other banks and could pose a risk to the broader financial system. So, last Sunday, the federal government stepped in to rescue Silicon Valley Bank and another failed institution, Signature Bank. All depositors will be able to get their money, even big accounts. The Biden administration insists this is not a bailout because the depositors, not the shareholders and executives, are the ones being rescued. Did the government do the right thing? And is the banking system secure? My next guest used to run Goldman Sachs, one of the country's largest and most influential banks. Lloyd Blankfein, good to have you back.
Fareed, good to see you. Thank you.
Now, I don't want to give you PTSD, Lloyd, but you remember 2008. You were in the middle of that. How is this crisis different from 2008?
Well, a crisis is a crisis, but it has different roots, totally different characteristics, very different. We'll see if it gets to the same dimension. For one thing, in 2008, the banks had bad assets on their books, or at least in many cases, investors, shareholders, the government couldn't assess what the value of those assets were. You remember subprime mortgages, were they worth anything at all? What were they worth? Here, you have the asset side of a bank's balance sheet is pretty good. Most of it is government debt, and then the government prints the money, so that's money good. The problem is that they took duration risk, that is, they invested in long-term bonds, and when interest rates went up, the piddling interest rate that they got on their bonds and their inventories went down in value. So in this case, and so that's sparked a bit of a concern among creditors and depositors, and so deposits left the bank. So in 2008, there were asset problems. In the current market, it's really a liability. It's really people pulling out their deposits, but the assets are probably in the long run money good, but they've suffered a loss of valuation in between. Also, the context is different. Banks today, financial institutions in general, are much better capitalized. I think the regulators and Congress in their actions post-2008 could take credit for that. And so we're starting in a much, much different place for the financial system as a whole. Doesn't mean there won't be esoteric issues in one institution or another, as was the case with Silicon Valley Bank.
And Lloyd, when you look at the situations right now, and it's a moving situation, but what the government has done right now, can most Americans, most depositors, all depositors feel our money is safe? We don't need to go to the bank to withdraw.
I think for the answer is kind of yes with an ellipsis, because the government, partly as a result of the reforms, you can query whether it was a good reform or a poor reform, took away the power of the Fed to just issue a blanket guarantee of all deposits in the system, which they did in 2008. Instead, it left them with the power, acting in concert with the FDIC and the Treasury, to, if they find a systemic emergency, to guarantee the deposits of entity by entity, bank by bank. I think what we heard from the Fed, that in this moment, in this fragile moment, they are implying that they will regard any event or any run on a bank as systemic, and the implication is they will use that authority that they have, but they can't announce that in advance, and they can't declare it. But they've come as close as they possibly can to do it, but they in fact don't have the power to issue a blanket guarantee. But I think it's good to. I think you're able to rely on it, but there is a tail risk in that lack of absolute certainty.
Now, there are a lot of people who feel that this is in some way a bailout, and this is in some way one more example of capitalism for the poor and socialism for the rich. That is, the whole bunch of these tech companies where their CFOs should have been managing their accounts properly, left huge amounts of money in uninsured deposits. Roku had $500 million sitting essentially in cash in an account. Presumably, there are other regional banks that made the same mistakes that SVB made that are now going to get backstopped by the Fed. Is it fair to say that the government has helped a lot of people who, in the normal course of capitalism, made mistakes and should have been wiped out?
Well, clearly, people who would have lost money won't lose money. So the answer is yes. I think they weren't aiming it at this one or this group or that group. They were aiming it at all the depositors, but with an eye to the systemic risk for the entire system. So the dragnet picks up a lot, picks up everybody when you do it. But it opens up what you're asking, what I think is really the policy question of guaranteeing deposits. And that's something that's going to have to be worked through. We have a $250,000 cap on what the government will guarantee. How sensible is that? The word that gets tossed around, the expression gets tossed around is moral hazard. That is, if you protect these depositors, they and other depositors in the future won't be so careful where they leave their money. And if they're not so careful, this situation is likely to recur. And the implication, the suggestion is that people should do their homework and do research on which are solvent institutions. Now, I won't deny that an institution capable of leaving $500 million in a single depository in a single bank probably has the wherewithal to do that. But really, in our financial system, do we want to make it the duty of depositors to do that kind of forensic accounting analysis on banks? We don't make people do analysis of airplanes when we board them. We rely on the FAA. If it's certified, we get on them. We do the same thing for drugs that get sold. If they're tested and approved, we rely on it. People aren't doing those forensics by themselves. We might think of extending that to some extent, maybe to a great extent, to deposits and raise that limit. But that's a policy decision that will take place.
Stay with us. When we come back, I'm going to ask Lloyd Blankfein whether these bank crises are going to tip the economy into a recession. And if they do, what should the Federal Reserve do? Because it's been trying to raise interest rates all along. And we are back with Chairman and CEO of Goldman Sachs. Lloyd, I want to understand what the future of banking looks like, what the business model, as it were. If the federal government is going to insure all deposits, in a sense, I mean, the whole business of banking used to be that you manage the fact that you're taking short-term money and you're loaning it out at long-term, you have long-term investments. If the federal government is going to guarantee you against any miscalculation, what is the model of banking? Is it become a kind of utility, a highly regulated utility for everyone?
Well, I don't think there's anything on the table to guarantee banks per se and their income and their solvency. We're talking about depositors here. But look, there's going to be a lot of wide policy debates are going to flow from this. Clearly, if we don't do this, look. The few biggest banks have very, very high capital standards and liquidity standards and stress tests. And the regional banks, even large regional banks like Silicon Valley Bank, have a much lower level of regulatory scrutiny and therefore kind of safety, let's be honest. And if you just left it like this, the lesson that people may walk away with is that their money is safer, maybe only safer with the largest banks, and so they're exercising their discretion in moving those things. The end of this game might be more consolidation, which was never an objective of the system. There's big policy debates here. You asked the future of banking. Is it a virtue that America has well over 4,000 banks? Most big countries have a few big banks with branches that operate throughout the company. We have branches that are dedicated to regions, that focus on particular industries. Silicon Valley Bank is an example. It may be the oil patch. Particular groups like some community banks and loan associations and connected to unions. We also have the fastest growing large economy in the world, and I'm not sure that that's not a reason. Our credit system for the largest economy is in the communities and in the industries and in the various sectors, and that's probably a good thing. I wouldn't necessarily want to experiment and withdraw that, but if we incentivize people to only go to the biggest banks, then the sector will consolidate beyond what people think is an attractive thing.
So, Lloyd, the Federal Reserve has been raising interest rates, and while it won't explicitly say this, what it's been trying to do is engineer a soft recession, right? By making money more difficult to borrow. It's been trying to slow the economy down. It's highly likely, it seems to me, that all these bank crises are going to do some version of that. So should the Fed stop raising interest rates?
You know, the market, as we speak here, the market is projecting better than a 70% chance that the Fed raises 25 basis points. I personally think it would be okay to stop here. To your direct question with respect to the current situation and the effect on the economy, it is a certainty that this situation will act in a way that's similar to a rate rise in some ways. Banks will have to, because of the tension, because of the pressure and uncertainties, banks will husband their equity. They'll do less lending on the deposits they have. And so already there's going to be less credit. Less credit means less growth. So some of the mission of the Fed in trying to slow the economy will be done here.
Lloyd Blankfein, always good to have you on. Thank you.
Thank you very much, Fareed.
Next on GPS, we are going to zero in on the collapse of Silicon Valley Bank. Did regulators miss obvious signs of trouble? What about the culture of Silicon Valley? Was that to blame? My next guest will explain.